Oh, all right. Well, good morning, everybody. It's great that you're here. It's April. I know it's a really busy time of year, but we are ready to have a conversation about something that might or not be keeping you up at night, tax rates, and all of the good things that and the fun that comes along with worrying about taxes. And we've got a fantastic guest that's going to be giving us some really timely information today. But first of all, just to introduce myself, in case you don't know who I am, Melissa Sadorf. I'm the Executive Director for the Arizona Rural Schools Association. And my co-host is Sean. Sean, you want to introduce yourself?
Sure. My name is Sean Rickard. I'm the superintendent of the Pima Unified School District out here in rural Graham County, Arizona. And I'm the president of the association. I have the opportunity to kind of come with you again today as we try to find some things to talk about that maybe are very interesting to our rural education leaders. So,
All right.
all right.
Well, and our guest of the hour is Randie Stein. Randie is the director, is a director in STIFEL's Public Finance Department and brings over 2 decades of experience in public sector finance. She's been providing those services since 2004, so has a lot of background that she's able to bring to bear. And she's held fiscal policy roles in the Arizona State Senate and with the JLBC, and is a recognized expert in education, finance, and state taxation with experience as an interim director of the Arizona School Facilities Board, and is also a frequent expert witness on tax and school finance issues. So, Randie, I want to turn it over to you and say thank you so much for being here with us today. I know that you've got a lot of great information that you're going to be able to share with us.
Great, thank you. Good morning, everybody. I'm gonna start with a little bit of property tax basics, just to kind of get us all on the same page on how this thing works so that we can get to the cap rate issue. Please, I'm hoping, I see several names that I am not familiar with, so I'm excited about that. But I'm hoping if you've got questions, you'll feel free to jump in, or if somebody else sees it in the chat or something like that, just let me know. The whole thing goes is a lot more interesting, at least a lot more interesting for me, if you've got questions and you've got other issues that you want to talk about. All right. All right. So this is the start of my massively confusing slide that everybody in my office would like me to change. And I absolutely refuse to do it because it is a depiction of the Arizona property tax system. Yes, it is massively confusing. So first things first, property taxes in Arizona are, there are multiple jurisdictions that have access to the property tax base, not just school districts. The cities, the counties, the towns, the college districts, even the state has access to the property tax base in one form or another. Property taxes are levied for two different purposes. We refer to them as primary and secondary. The primary is maintenance and operations. The secondary, school districts are most familiar with it for voter approved bonds and overrides, but the secondary is also where the special district tax rates are going to be levied. Fire districts or community facilities districts, all kinds of special districts out there. Just not to make anything easy, property values in the state of Arizona, two different entities are charged with that responsibility. Locally assessed property is valued by the local county assessors, whereas centrally valued property is valued centrally by the Department of Revenue. What those two different types of property are, locally assessed is, mostly houses and standard commercial buildings. The Department of Revenue is charged with valuing the stuff that sort of falls into two categories. Either it crosses county lines, like a utility, or it is something that is not readily bought and sold. Mostly, I think of that as a mine. Houses obviously turning over all the time, an assessor can get a comp, But when you're talking about a mine property, these are not things that change hands very readily at all, and they have a special valuation method. We also value two types of property in the state. We value real property and personal property. Real property is what you think of, the land, the house that's on top of it, the strip center. The personal property, I think the most common thought is, desks and computers in some sort of commercial office building. That stuff actually pales in comparison to some of the very large pieces of personal property, either giant truck type equipment that you might find at a mine location. But also my favorite example is the silos at Palo Verde, the electricity generating silos, the way they are not connected or not affixed, they in fact are personal property. So this stuff can be very, very large. There's also personal property in something like an Intel clean room, and that's very expensive property as well. So personal property, don't poo-poo that. That can for sure be real. I can't remember if we get to it in this presentation, but just as an aside, personal property is not the stuff in your house anymore. It used to be the assessors came knocking on doors and looking at china and silver. That is not the case anymore because there is literally an exemption in the state constitution for household goods. And then 4 types of tax rates. The obvious one is a rate-specific tax rate. CTEDs, they have a 5-cent property tax rate associated with their operating, but very few tax rates are actually like that they're just a set dollar amount. Most of them are calculated every year. A school district's familiar with bond debt service or an override. You get an amount, you know the value of the property, you do the math in order to come up with the tax rate. The tax rate is not out there prescribed for you. Same with that state qualifying tax rate, that QTR, that's set by a truth in taxation mechanism every year. To the degree the value of property goes up, that tax rate goes down. And then last but not least, we also have multiple property values in the state. Market value, which, it's easiest to talk about houses. Market value, kind of what you think you could sell your house for, or, the Zillow estimate for it really has nothing to do with the property tax system, nothing at all. The 2 values that are identified in a notice of value that you'd receive every year is the full cash value. That is the one determined by the assessor. They call it akin to market value, but truthfully, it is intentionally somewhat lower than market value. And Department of Revenue works with the county assessors to kind of keep that even across the state. The number one reason that they do that is so it takes pressure off the appeals process. So when you appeal your property value, what you're appealing is the full cash value. And, honestly, if you get a notice of value that says your house is worth $85,000 and you think you can sell it for $110,000, we all kind of go, great, I'll let that go. Of course, if it was a lot closer to that, you'd be a little bit more concerned. Again, relieving the property valuation appeals process. The limited property value is the one that we use for tax purposes. We use it for all tax purposes. I'm hoping at least some of you are as old as I am and can remember when we used to tax on both the limited value and the bonds and overrides were on the full cash value. That is no longer the case. Only taxes applied to the limited property value. And then the assessor uses, the statute prescribes assessment ratios for different classes of property to differentiate the burden among classes of property. All right, I'm moving on. Any questions on this? Okay. So a little school finance basics, just bring us all together here. That school district qualifying tax rate, I think of it, the only purpose of that tax rate is to determine the mix of local funding versus equalization assistance for that guaranteed funding formula. You're all very familiar with that. You know that the guaranteed funding formula has all kinds of components, a giant spreadsheet, all the numbers go into it, the number of students, what grades they're in. If they've got special needs, you've got a small DAA component, you've got a small transportation formula, and like magic, it comes out, that is your guaranteed funding formula for the year. Well, then the question becomes, where is that money coming from? The answer is they're going to start with the qualifying tax rate, which means the local property tax base. If you can see this, you can see that starting in, my numbers just start in fiscal 11, but from fiscal 11 through 14, the qualifying tax rate was actually going up. And what that means is that the value of existing property, value of property statewide that existed in the prior year, I'm going to say that again, the value of property statewide that existed in the prior year was going down. That's the trigger for setting the rate. Now, of course, the rate is then applied to all the property, not just the stuff that existed last year, the new construction also. But the trigger on the rate is the value of last year's property in today's value. And it was going up because a couple sort of interesting, marginally interesting points here. Because what was happening is in 2008, 2009, 2010, those property values statewide tanked. Well, we have a lag in the valuation cycle, and it actually took a couple of years before property values started to decline. But when they did start to decline, the qualifying tax rate started to go up. And then you can see it's been coming down. It's been coming down ever since. Value of existing property has been increasing. And I actually hope almost everybody has seen this little chart before. I've got 4 fictitious school districts, all that magically have a guaranteed funding formula that popped out $1 million for this year. So the green district, when you apply the qualifying tax rate to the local property tax base, it would generate $1.2 million. I'm sure many of you would like to have that extra 20%, but that's a no-no. So what happens is that in that school district, instead of levying the qualifying tax rate for the M&O budget, you're levying slightly lower than the qualifying tax rate. My red school district, it's like magic. It's even. You apply the QTR, that school district gets $1 million. The state sends you nothing. Most school districts are the gray school districts. You apply the qualifying tax rate, you're entitled to $1 million. It only gives you $550,000. And so you get equalization assistance equal to $450,000. Some of you, I'm sure, are quite familiar with the yellow school districts. When you apply the qualifying tax rate, you would actually get more than twice that $1 million. So the state has a line there. They say you got to levy at least the minimum, at least half of the qualifying tax rate. In this case, it would generate $125,000 too much. And so that gets remitted back to the state to be used for education purposes. We good here? Oh, good, Sean.
Well, I mean, and I would just, I don't know, just something I've been looking at for a while, but I mean, what that means too is when you go to add bonds and overrides, that secondary tax rate, that you could have districts that are actually still, with a tax rate below the QTR, but they are able to spend, because the voters approve it, up to 1.2 million plus whatever bonding and other capacity.
Right. But that will be on the secondary rate, not on the primary.
Right.
Which is actually a key aspect of the rate cap issue.
Shanna, if you have a question, unmute.
Yeah, go ahead.
I did. So on the yellow school, so explain that yellow one to me again.
Okay. Hi, Shanna.
Hi.
So this is a school district that has a lot
Okay.
of property value per student. It probably has an electric generating facility in the district. It has something like that.
Mm.
And what happens when you apply the qualifying tax rate, because there's so much property value per student, it would actually generate $2.25 billion.
Hey, how are you, Kika?
State does not let you spend that 2.25 unless you've got separate voter approval someplace
Yeah,
else.
just let me mute this. Hold on.
But the state, so you would actually, so if you were just funding your $1 million, you would be less than half the QTR. State doesn't let that happen.
Sure.
They say there's a minimum QTR of 50% of what everybody else is doing on the QTR. So you got to levy that full 50%, but that little slice that's still over the $1 million, 125,000 here, gets remitted back to the state. This also happens in Cave Creek Unified. A lot, so they don't, no electric plant or anything up there, but they've got a lot of property value per student, and on their tax bill is this minimum QTR piece also.
So like back to the turquoise one, the 1.2 million. So the excess, does that go back to equalization?
No, that doesn't get levied. The
Oh.
difference between that turquoise and the yellow is in the turquoise, while that school district won't levy the full QTR, they're going to be they need over half the QTR.
Okay.
So in that band, at least half the QTR, they just reduce their levy slightly below.
Okay.
They reduce their tax rate slightly below the QTR.
Okay.
And there's not a lot of yellow districts. Although, yeah, there's not a lot of yellow districts at all.
So in my easy language, in the yellow district, they can only take the $1 million that because that's the revenue control.
Right. Unless we're talking about an override someplace, voter approved someplace else.
Secondary.
Yes.
Right.
No,
Okay.
their guaranteed funding is still only $1 million. And that's actually what I think about here is
Okay.
that the Arizona system is do the best with the formula funding that we give you. It's not determine what you need and then tax for it, which would kind of be the yellow. We need a lot and we can tax for it, but that is not the system we have. We really have a system that says this is what we've determined you're entitled to, so do the best you possibly can. And it's also, just to make sure this sort of concept is clear, but the determination of the guaranteed funding formula and what the state will support every year for the, operations of the school district is determined completely separately from that qualifying tax rate. They only come together for purposes of determining this mix of local funding versus equalization assistance. They do not depend on each other at all when they're being calculated, which is a little bit weird. Kind of a disconnect between, how much you're going to spend and what the revenue is. So, okay. All right, let's talk a little bit about the property tax rates. And, let me, oh, great. I have the page I was looking for. Good. So a couple examples, rate specific, that CTED maintenance and operation rate, that 5-cent rate, the fire district assistance tax rate, which I think is capped at 10 cents statewide that we're all paying. The one big one of these is for community facilities districts. They do have they are permitted to levy a maintenance and operation rate. I think it's $3.25, so that's pretty substantial, but it's not in very many places across the state. The levy-specific rates, mostly for school districts, I think the easiest way to think about that is if you've got outstanding bonds, you've got a debt service every year, or if you have a voter-approved override. Now, what's key about this is these rates, or excuse me, these dollar amounts that you're going to levy every year change every year. It's not that they're fixed, it's that they're known. So as you go into fiscal 26, if you have voter approved, if you have voter authorization for an override, you know how much that override is. If you've got outstanding bonds, your debt service number may be, $1 million in fiscal 25 and $900,000 in fiscal 26. It changes, but you know what it is. And so the math on that is that debt service amount, $900,000. We learn the property value for all jurisdictions. We get a preliminary number in February every year. We get the abstract in April, and we can calculate the tax rate, the property tax rate that you need to pay that $900,000 in debt service. So the known number is the debt service amount or the override amount. You do the math and you get the actual property tax rate versus the rate specific. The known number is the tax rate. You do the math and you go, oh, I'm going to get $450,000 on that, or $425,000 next year. But that's the one that you're doing. It's the dollar amount that you're doing the math to get, as opposed to the rate that you're doing the math to get. The cities and the counties and the college districts, their levy limited rate actually works quite similar to the QTR. So again, the trigger on those rates is based on this year's value of last year's property. So for a city, for example, if they could levy $100 last year, the Constitution says they can levy $102 in the current year based on the value of existing property. So they do the math, they figure out the new tax rate, and then they apply it to all the property, the new construction also. So they have a 2% growth built into it, plus new construction. If the value of the property in this city increases by more than 2%, the levy can increase by 2%, the rate goes down. We saw that with the QTR. The QTR is a 0 increase threshold. The cities have a 2%, same thing. When the value of this property statewide, the stuff that existed last year increases, that QTR goes down. And it is designed that way for those property tax rates to be edging down. Should I pause on this? Keep moving.
Well, there's got to be a question on that. You got to be kidding me.
Yeah. And then
A
this
lot.
is kind of
Yeah.
one other look at it is if you're a property tax payer, this is what matters to you vis-a-vis determining your liability.
Right.
Are you seeing my cursor here?
Yeah.
In the rate specific, the only thing that matters to you is what the value of your property did. It's 5 cents for that CTED no matter what. If the value of your property doubles, you're paying twice as much for the CTED. You're probably not worried about it because it is only 5 cents, but you're paying twice as much. On most of these other tax rates, let's leave the state thing alone, it's really a piece of the pie. So as long as you grow at the same rate as everybody else, you're just paying your own piece of the pie. What you get worried about is when the value of your property doubles, but your neighbor's doesn't. Because then you're a bigger percentage of the jurisdiction. You're a bigger percentage of the school district override or the school district debt service. So it's, a couple drinks later, it's marginally interesting that the taxpayers pay all of these tax rates on their bill, but they're all impacted by something different.
So is that why when like for my district, I have no solar plant, I have no industry, I just have a bunch of farmland. But if we get this cobalt plant out here, woohoo, so that helps my homeowners. I don't understand how or why, because so much value is in that business.
Right.
So yes, that will be a huge amount of property value. So whereas your house, maybe it used to be, 5% of your total school district, when that thing comes in, it's going to be 1/2 of 1% of your total school district. And unlikely that your override amount is going to increase by 10. So they, they are now paying a much smaller percentage of your override than they previously had been. Yes.
So we have an override, so that's okay. So since I'll have a better tax base, my
Yes.
override could potentially increase just because there's more tax value.
Your override would only increase if you get more, if your ADM changes.
That's what I thought. Okay.
But I guess the point I was trying to make is that with that kind of addition of property, you're unlikely to have a similar addition of students.
Right.
Now, it's a little bit of a different story when you're talking about housing developments, right? Because kids theoretically come with housing developments. But when you're talking about a commercial intensive property like that, there may be some additional people there and some additional kids there, but the relationship of the additional kids to the additional value will pale. And do you levy the QTR in your district?
I don't know. I don't know.
Okay, I think you would know if you didn't. But the addition of that amount of property, depending on how big it is compared to your school district right now, it could bring you below the QTR.
Okay.
And if you really think that's happening, we should talk about that.
I don't know.
Offline. Yeah.
We have an M&O override. I know that. But
And yeah, I think that would go down, but you could see a pretty drastic reduction in all the tax rates levied by the school district.
that's what I'm thinking.
Yeah, but that might be an opportunity for you.
Yes.
Yeah. Okay.
Krista?
Yep,
Yep.
I have a question about the commercial
Oh, hey,
industries.
Kristen.
For the commercial industries within a district, I know I'm wondering, do they all depreciate? Which ones depreciate? Because if it is like your biggest revenue source and is depreciating at 3% a year, like it does change quite a bit over a 10-year period of time. But I'm wondering what industries are included in the depreciation of assets.
So that's a great question, and it is complex. The Department of Revenue has manuals on depreciation, and personal property definitely depreciates. And it's incredible, all kinds of, or the number of schedules that they have for the different types of personal property. Now, you've also brought up something, sort of a tangential subject, but in 2022, all of us statewide, we voted for a constitutional amendment that looked like apple pie because it was to give the legislature additional authority with respect to setting thresholds for military veterans and their property taxes and disabled widows for their property taxes. Like, how bad could that be, right? But the other part of it also gave the legislature discretion with respect to setting the exemption threshold for commercial personal property. And they have been, over the last couple of years, moving towards further exemption of commercial personal property. So while personal property is depreciating, they passed a bill, I don't know, 2 years ago or something, or just last year, that there are certain types of commercial personal property that go on the property tax rolls so low now, you'll just never see them. And in fact, your commercial personal property may actually decline because the stuff you have on your tax rolls now continues to depreciate, and the new stuff isn't replacing it because it goes on at a value that is so low. So that's a great question. And you have solar farms, right?
So we have a solar farm. This, like, I'm watching like your graph before that showed all the different QTR levels.
Yep.
So I've been all of them is where I feel like I have been. And when it initially came on, our assessed value went so high that they
Yep.
were taxing quite a bit to put in for the state aid for other districts, right? So it was going to the general
Yep.
fund, and we saw that as a separate tax item
Yep.
on the tax roster. Now we're getting state aid again, because I know the Department of Revenue. I know that there was a law passed in Arizona as well that if you get any grant funding for the construction of these types of commercial properties, which was a huge solar farm in our district, that the grants you receive do not count in your assessed value. And so ours had gotten $500 million. And so the assessed value of that, it quickly depreciated from there, and it's continuing to go at 3% a year. But I know we just had like a methane plant put in, and it didn't increase the assessed value in our district at all. But I do feel like I should be an economic developer and try to like, hey, come to Paloma. I don't know, but
So when did the methane plant go in?
I would say, I think 2 years ago.
It may just be slow to show up on the tax rolls.
Okay.
But the 3% decline that you're seeing on that commercial property, the assessment ratio for commercial property is still declining. Now, it's at 16.5% right now. It is declining by a half a point, 16.5 to 16 to 15.5 to 15 over the next couple of years. But if you do the math on that, that is 3% of the commercial property is declining. So that may be why you're seeing that and not depreciation. That is not the depreciation factor, it's the assessment ratio decline.
Okay. And that could be, well, and then, so we also have farming, but that's commercial personal property. Is all of that depreciating?
That's going to be ag. That's going to be in the agricultural class, I believe.
Okay.
Which is a special valuation.
I don't know. We've just seen a decline at 3% a year for years
on the commercial property.
I haven't divided it that much. I will say our overall assessed value has been decreasing by 3% a year.
Yeah, I think that is a large degree because of that assessment ratio decline. And it's interesting that, sort of your property value otherwise is so stable that you see it so clearly.
Yes, very, very.
Yeah, there's a ton of noise in property tax and property value, but it's interesting that you can see it so clearly because of your specific circumstance.
Yeah.
But I think that's what it is that assessment ratio, and you're going to see it for another 2 years.
Thank you.
All right, this is a property tax bill. I can't remember which school district it is. It's obviously someplace in Maricopa County. I like to show you this for a couple different reasons. This is a total tax bill of $13, not uncommon in certain places around the state by any means. This is a $3,800 tax bill, but you can see the school district is a huge part of it. Property taxes for schools, the comm colleges also, you know, you got another 350 here. This funding formula was just shy once you had the homeowners rebate piece. This is $800 that's in the unified district funding formula. They've got another, you know, 700 and some dollars that's in the voter approved bonds and the voter approved overrides. So, you know, you're talking $1,400 out of this total tax bill that is just associated with this unified school district. And then all these other little special district things you see below. The one that's big that we mentioned earlier is this community facilities district. You know, that's popping up at almost $900. But the big portion of almost everybody's property tax bill in the state is K-12 education. That is by design. Nobody's doing anything wrong. That's how the system works. They wanted K-12 education to be funded off of that local property tax base. The other thing I'm showing you is the limited property value of this house was just over $300,000. The full cash, that's the one that you pay the taxes on. The full cash value of that house is $666,000. I looked this up. This is somebody's house. I can't remember whose, but it's somebody's house. I look them up. And that discrepancy right now between the limited property value and the full cash value is not uncommon. That's a function of this current real estate market because those full cash values increase. Again, they're akin to market value, so there's no limitation on how they change every year, whereas the limited property value is only on a house only permitted to increase 5% a year, but can never be more than the full cash. So there's plenty of 5% increases left in this split, unless we saw what we saw in 2008, 2009, the tanking of the real estate market. Then we might sort of get worried, is that house really going to have room to increase? The other thing that's out there is the Zestimate. You know, it's a very formal, carefully calculated number, but sort of what you think you could sell your house for. And in this case, I hope you're seeing it. Mine has a little blob over it, but it's like $800,000. And this is not unusual that you would see this kind of disparity in the property values for a house right now. All right, we're to the cap issue. So the cap originates, the statutory authority is 4251. And the gist of it is a two-pronged test. The first one, does the school district primary property tax rate exceed 150% of the applicable qualifying tax rate? So it's adjusted if you're an elementary district versus if you're a unified school district. That is adjusted there. And then does the total primary property tax is levied all jurisdictions, not just the school district, every jurisdiction that that house fits in, at least 50% of them, are they exceeding a $10 tax rate? Let's think about this for a minute. The Constitution says 1% of the value of the house. That is equating to a $10 tax rate once you apply the assessment ratio. Now, you get state aid. So, here, this test is net of the state aid. So after you get that homeowner's rebate, which is 50% of the QTR or 50% of the qualified tax levy, after you get that, is it still over $10? So if you got half your residential property, still over $10, and that primary property tax rate is over 150% of the QTR, you get triggered. And what you get triggered with, I affectionately refer to it as a nastygram. You get this letter in the mail, I think it comes in December, from the Property Tax Oversight Commission, and it says, you got a frozen rate cap. And what they do, the penalty for this, is it says you cannot have a primary property tax rate for the school district that's higher than the current year. Honestly, that may or may not be a penalty. You may be fine with it. You may not be, but you may be fine with it. Questions on the background on this? Two-pronged test. The result is a nastygram that comes to you from Property Tax Oversight Commission that says the rate that you have right now comes in December. So, if you got it in December of 2024 for fiscal 25, you have a rate cap for fiscal 26, and you know exactly what it is. All right. Most common situations where this happens. Small school district adjustment. Anybody ever had that one? I think Paloma's had it. I assume Mohawk's had it, right? Nope.
We have it, but we haven't triggered anything with it.
I think it had been triggered in prior years.
Not since I've been here.
Okay.
So
Mohawk doesn't have small school adjustment yet, but I think it got triggered at higher this year.
Okay. School districts that have access to that desegregation tax levy, that's also a common place where you see it. Or you used to see it because the deseg levy used to be on the primary. It now looks like the courts have sanctioned it to be moved to the secondary, so it's out of the question. The small school district is on the primary. The other place you see it is in when the school district exists in a city or a county or both that also has high property tax rates. So you can't control that, but that's where you see it. Interestingly, this is less, there is less and less occurrence of this currently because it is a tax rate cap. And I told you that the qualifying tax rate, big part of the property tax bill, the city or the county primary property tax, all those tax rates edge down as property values grow. So property values have been growing for like the last 10 years, and it's still the $10 test. But as all those rates come down, we're seeing less and less occurrence of triggering the tax rate cap. In this statute, there is no reference to any tax rate, a practical or a single tax rate limitation. It's just you're capped at what you are at now. Go ahead, Kristen.
I have a question about that. I was helping someone in Mojave County, and they had a very high primary tax rate for their like a firefighter district or like some kind of where it was higher than the levy for the school district. It was a much higher levy. Um, do those other industries get capped ever? It's only the schools, even though they all contribute to it. Wow. Okay.
Yeah, that is the problem. This other jurisdiction that you exist in. I think Pinal County has notorious, and primary property taxes for like counties were, I don't know, 40 or 50 years ago, or we're just like set. And so, okay, it's what you have now. And then you have a mechanism for calculating for future years. And so some counties were like 24 cents and some counties were like $2. So it's very disparate. I think Pinal County and Pima County are known to have, relatively high county tax rates. And we would see more incidents of this with school districts in Pinal County. The other interesting thing about the tax rate cap is that the statute says nothing about reducing your budget. It just caps the tax rate. So there have been school districts in the past, and it depends on the county that you're in, how this works out, but literally could be running a cash deficit. And, you're not overspending your budget, right? Your budget was calculated completely separately, the guaranteed funding formula, you can spend $1 million. But, they've capped your primary property tax rate, so you can't collect what you need. And so you're literally running at a cash deficit. The statute says nothing about reducing that budget. I don't know if that's intuitive, that if you're collecting less, you have to reduce the budget. I don't know. Because we have a system that says, this is what we promise to support for you. Go forth and do the best you can.
Kristen.
Yeah, I was just gonna share my story. Sorry if I'm talking a lot, but that was what happened to us in like 2019, where our solar plant had won that $500 million assessed value adjustment on their full cash value. It wasn't the limited cash value, but it was on the full cash value that we had not been made aware of in any kind of form. And that was when the county treasurer was switching to their new system. So all of the reconciliations were months behind. I mean, like 4 or 5 months behind. So we found out in, I think, 2019 that the solar plant had won their assessed value appeal that went back years and years, of course, to like the first time they had their assessed value, and they did not have to pay $1 million because it was over multiple years. And we just didn't get that money. We couldn't spend it. Our budget was still very high, but we had to cut spending everywhere. So it looked like we had a ton of budget capacity, but we had no money at all. And then we just had to write it off as a loss later on. So that was a lot of fun. A lot of fun.
Thanks for
Yeah,
sharing.
and go ahead.
No, I just was saying thank you. I mean, I know that that's something
Yeah.
that we all hope we don't have to go through, but it can happen. So
And unfortunately, in smaller school districts, something like that is, the impact of it is just outsized. If that happens in Phoenix Union, it's literally noise. But, in smaller school districts, and, even in fact, there was a situation with a hospital exemption or something. The hospital was in Phoenix Union and Phoenix Elementary. The impact in Phoenix Elementary, massive. The impact in Phoenix Union, noise. Yeah. So my thoughts on getting out from under the rate cap, and not like this is foolproof or anything like that, but if you can get out from under it for 1 year, you can reset that primary property tax rate the following year, and sort of with a mentality of go big or go home. set it at a level that you could live with for the next several years. Of course, there are taxpayer ramifications to that, and that may not be feasible, but that would be the strategy. Squeak under it, squeak under the nasty gram threshold for 1 year. Once you're out from it, you're not capped anymore. And nothing says, not necessarily a great idea, but nothing says you can't have an $8 tax rate. I mean, if you're going to be capped, think about this. If you're going to be capped, why be capped at 332 when you can be capped at 8? All right. Of course, we're ignoring taxpayer ramifications, but that is sort of the mathematical concept. It is also challenging, not just your taxpayers, but it is also challenging because you don't control all those other jurisdictions.
You're like,
Not all cities, not all counties are at the levy limit, and they retain the rights to the levy limit amount. They could be increasing primary property tax rates and nudging you into nasty gram territory again, even though you were judiciously trying to come under. So that too can be a problem.
Hey, Randy, I just want to point out we're getting close to 11. And so
Good.
I think it's a great discussion, tons of good information,
and we're done.
I was going to say that slide says it all, right?
Yep. Yep.
So one of the things that I know comes up around these tax discussions, and I don't know, it doesn't seem to be that well understood by policymakers, but is the fact that there are things like adjacent ways levies, there are like transport levies that are basically, I mean, they're board approved additions to the tax rate, that again, depending on what your per pupil assessed valuation is, can have disproportionate impacts in some areas. I know a lot of rural areas, boards are very reluctant to pass adjacent ways taxes because even though it's a small amount, it pushes more.
Right.
So.
And sometimes, I see it in the urban areas as well as the rural, is, some sort of baseline adjacent ways levy that continues so that, you see a project coming up, 3 or 4 years from now that you have a few years to spread that out.
Right.
Natterburg, over the last couple of years, their board approved a very substantial adjacent ways. I mean, with a lot of, discussion and consternation, but they wound up in a situation with an SFB school, but SFB doesn't do your adjacent ways. And, similar situation, it's a pretty small tax base out there compared to building a high school that is, a little bit, that is not adjacent to the area. You got streets, you got to pull sewer, all that kind of stuff. And they made the hard decision to levy a pretty substantial adjacent ways. I think it was $6 million over 2 years in order to get that school completed. Yep, that always a challenge.
We've got about 5 minutes left. What other questions do people have?
Well, you can always reach out to me. I will send, I'm just making sure I have my contact information on the front page here. Yep. I will send the deck to Melissa that she can send out. And of course, please reach out to me if you need anything. It was good to see people. And if you've got follow-up questions, shoot me an email, give me a call. I'm always available.
Thanks, Randie. We really appreciate it.
Sure.
All right. Well, with that, I think we are adjourned, and enjoy the rest of the month. Take care. We will have a special session in May with Jim Rounds. We're going to get him on to talk to us about some of the things that are happening up in Phoenix that might impact your work as a rural leader. So look for information on that special roundtable coming out once we get it scheduled with Mr. Round. So take care, everyone, and enjoy the rest of the day.
Thank you, everyone.